So right now in the existing framework, gold is the primary neutral reserve asset that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up and comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. That's kind of half the point. But I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Before all this kind of tariff kerfuffle, I would have kerfuffle. I would have had a higher, I would have had probably a higher price target. If I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say the U.S. bond market broke, the Fed came in and basically did yield curve control or kind of QE that they don't really want to be doing, or some sort of big Treasury operation twist sort of thing. It would probably take something like that combined with some sort of de-escalation of tariffs.
As Bitcoin hovers around the $85,000 mark, the spotlight is on what could launch it to historic highs or send it crashing back down. In 2025, Bitcoin stands at the crossroads of two powerful forces: rising U.S. China trade tensions and a fragile, wobbling U.S. Treasury market. While some analysts are still chasing the dream of six-figure Bitcoin, others warn that without a fresh wave of liquidity, those lofty targets may stay just out of reach. Respected MicroStrategist Lyn Alden brings a measured perspective. She sees potential for Bitcoin to double over the next year, but her baseline remains grounded, aiming for a move just north of 100K. Her outlook has been tempered by recent tariff fears, which have cast a shadow over earlier, more bullish projections. But here's the kicker. Alden believes the real catalyst could come from a breakdown in the bond market. If the Fed is forced to intervene with yield curve control, another round of QE, or emergency liquidity injections, that's when Bitcoin could go parabolic. Without such a shock, steady but unspectacular gains might be the most realistic path. The stakes have never been higher. Bitcoin is evolving beyond a speculative asset. It's quickly becoming a global barometer for monetary instability. If Treasury markets falter or trade wars intensify, BTC could soar as a hedge. But if the Fed holds the line and tensions cool, its climb may be slower and more methodical. So, digital gold or just another risk asset? This year could define Bitcoin's identity once and for all. Don't miss this. Watch the full Lyn Alden interview for exclusive insights you won't find anywhere else. Smash that like button, subscribe, and hit the bell so you never miss a beat in the world of crypto and macro. The road to 100K or beyond starts here. Let's dive into the video.
Sure. So the global reserve currency means that countries around the world predominantly use the dollar, in this case, for a lot of different purposes. One is international contracts. So when units are determined for what you're going to sell oil in, or even what you're going to sell a lot of other goods in, it's often in dollars, even if it's between countries that both don't use the dollar. It's kind of like the biggest ledger that they all kind of attach to in the unit of account sense. It's also the primary funding currency, meaning that if an entity in Europe, for example, lends money to an entity in South America somewhere, it could be a government, could be a corporation, there's a good chance it'll be in dollars. Occasionally it'll be in euros, it could sometimes be in local currency, but often it's in dollars. It's also used as a reserve asset. So because these countries around the world have liabilities, either in the contractual sense or the debt-based sense, they often also store assets in dollars. And then lastly, it's the most liquid trading unit. So, for example, if you're looking to trade between South Korean currency and Brazilian currency, instead of trading them directly, you'll often trade one to the dollar and then the dollar to the other one. So the dollar is on one side of the vast majority of FX transactions. And so because it serves all those purposes, it's basically the biggest ledger in the world that all these different ledgers connect to at the top down sense. And so what it means is that there's extra demand for the dollar. And there's kind of a couple different levels of demand. So on emerging market currency, generally there's not a lot of external demand for it. other than when you're directly interfacing with that country. Certain large developed countries have a little bit more demand for them, but not much. It's still generally when you're looking to interface with that country. Whereas the dollar, because it's the biggest, most liquid, most saleable ledger out there at the current time, is used for all these different purposes, even if you're not currently using those dollars or intending to use those dollars to buy goods or services or assets in the US. So there's this extra monetary premium for the dollar. And then the next question is, so the whole world needs dollars for all these purposes. How do they get the dollars? And the mechanism that happens is that because they all need the dollar, they're structurally and like involuntarily overvaluing the dollar. If you look at it on like a trade basis or an interest rate differential basis, there's this kind of structural bid for the dollar which overvalues it. And then what happens is that because the dollar is overvalued in the system, it becomes rather uneconomical to produce a lot of lower margin goods in the U.S. It's one of the most expensive places to do it, even compared to other developed peers like Germany, Japan, Singapore, whatever the case may be. It's harder to manufacture in the U.S. even compared to a lot of other wealthy nations. And it also it boosts our import power. So Americans, because the dollar is so strong, we can travel around the world. We can buy a lot of Chinese goods, and so what that does is that kind of forces open our trade deficit. Um, because it impairs our export competitiveness and boosts our import power kind of artificially. And so what we do is we just flood dollars into the world to the tune of like $1 trillion a year to the rest of the world every year. And that's how they get the dollars they need to continue using the dollar as the global reserve currency. And so that's why, at least in the current system that's been in place for like 50 years or so, that's kind of why they go hand in hand. They're tied at the hip. People often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. It's a big mix of a lot of different things going on together that happen to be in one political entity. And so that status basically empowers certain parts of the economy, certain people in the economy, and then it hurts others. And so, for example, if you're in Washington, D.C., and you want to be able to sanction almost anyone in the world, it's nice that everyone's using your ledger. It makes it harder for any entity to go around it. Not impossible, but your sanctions are rather powerful compared to if Canada's sanctioning you, for example. You get a lot of leverage that you can basically pressure other countries with. You have the rest of the world financing part of your deficits because they have this kind of structural need for assets. It's generally good for the stock market because all this capital, what countries do with it, there's often this thing that people say, well, we're sending them pieces of paper and they're sending us goods and services, which is true, but then there's one more step. With those pieces of paper, they go and buy our financial assets. So they buy our stocks, they lend to our corporations, they buy our private equity, they buy some of our real estate. So what we're doing is we're selling portions of our appreciating assets to the rest of the world, and we're acquiring some of their depreciating assets, goods and services, which are useful, but they're different than appreciating assets. And so the problem is, so like running a trade deficit for 1 year or a few years is not a big deal. Deficits come and go. Different countries go through these periods. The problem is that when it's structural, due to the reasons I previously described, when you have 50 years in a row of trade deficits, you get a really big imbalance. We've like stacked all the cards on like New York, Washington, Silicon Valley, basically the coastal cities, and we've really kind of kept taking from a lot of the heartland area, except for the farms, but we've taken a lot from all these industrial places. You get political changes, you get national security challenges when you realize like you're reliant on your military components to a kind of alarming degree, from foreign sources, or you realize that a country with less GDP than you can pump out missiles faster than you can, just because your manufacturing base is not disproportionately bigger than theirs, even though your economy is. So it has various implications as it builds up for decades.
The crypto market's been treading water lately. No real sparks, no wild rallies, but that could be about to change. Enter Binance. The world's biggest crypto exchange just dropped a bombshell. It's actively helping countries explore how to build Bitcoin reserves. Yep, you read that right. CEO Richard Tang revealed that following Trump's bold push to stockpile digital assets, other nations are now paying close attention, and they might be next in line. While Bitcoin's price is still moving sideways, This behind-the-scenes shift could be the sleeper catalyst the market's been waiting for. Sure, things feel a bit stagnant now, but Bitcoin's dominance is holding strong, and some analysts are doubling down, predicting BTC will continue to outshine altcoins through the rest of the year. So, what happens next? Will Bitcoin be the next big sovereign asset? Or is something even bigger brewing beneath the surface? One thing's clear. In crypto, the calm never lasts for long. Dive into the full interview for the inside scoop on what could be Bitcoin's next breakout moment. Like, subscribe, and hit that notification bell. We've got more explosive updates coming your way. Stay ahead of the curve. The next crypto chapter is being written right now.
So right now in the existing framework, gold is the primary neutral reserve asset that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up and comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. It's kind of the half the point. Whereas the reason gold can't kind of by itself be the best global reserve asset is because then you need this like layer of credit on top of it. Whereas Bitcoin can function on its own. In addition, when we've seen these other countries try to go around the dollar, they're always trying to build these like systems to interface with each other. So all these like closed systems, trying to figure out how to do cross-border trade. While there's this really powerful open source solution kind of staring them in the face. Now, it is understandable that they've not rushed to it because using the Bitcoin network means owning volatile Bitcoin. It's also still fairly small compared to the scale that the world would need for something like this. So there's some degree of career risk of being early, for example, but it is kind of reaching the scale where I think that countries will increasingly take it seriously. And so both as a neutral reserve asset and as a global settlement network, that's very powerful. In addition, all the existing things already has. Basically, if you're in a place that's authoritarian, individuals can benefit from Bitcoin as well, rather than just countries at the sovereign level. So the kind of the full stack and down, I think is pretty powerful. And then in addition, we just talk about AI. It's hard for AI to get bank accounts. It's easier for them to spin up a wallet, and so I think that it makes sense that Bitcoin is a powerful tool for AI agents in the future as well, microtransactions, things like that. In addition, there's also like a lot of kind of existing software. When they face things like credit card fraud, where you pay for their services and then cancel, get your money back, they didn't really lose much by giving you that service temporarily because it's a high margin business. Whereas AI services are pretty hardware based. They actually incurred a cost. And so they have a higher stakes in avoiding things like chargebacks and fraud and things like that. And one of the advantages that Bitcoin is at least done certain ways, it's final, which matters more for certain types of payments than others. So I think that Bitcoin fits in multiple ways into this vision of the future. My guess is that we end up higher at the end of the year than we are now, at least. There's a lot of variables that could affect that. So I think that most days where you have a big down day in markets is probably not going to be a good day for Bitcoin, just because most pools of capital treat it as a risk-on asset. It's still small, it's still volatile. A lot of times, especially because it trades 24/7, if people are worried about how things are going to open on Monday, some pools of capital can sell their Bitcoin on a Sunday and prepare, right? So the 24/7 can sometimes, add to its volatile pricing, especially when TradFi markets are freaking out, because we're talking about like a sub $2 trillion network compared to this like multi-hundred trillion dollar global behemoth of interconnected finance and leverage. So Bitcoin, I think, will get shoved around by volatility. As this kind of settles a little bit, if you do get ongoing capital outflows of the US, that actually could be good for Bitcoin. Sometimes people ask, what could make Bitcoin more meaningfully disconnect from the NASDAQ? But one is anything that hurts NASDAQ margins, but that does not hurt global liquidity, which should generally be somewhat supportive of Bitcoin, minus certain particularly volatile periods. But then it more structurally impairs the NASDAQ, the S&P 500. We saw similar to this in the closest period to maybe look at or study is the 2003 to 2007 period. That was the prior weaker dollar cycle. There wasn't this kind of like mass excess of capital, but there was around the margins. Capital went to emerging markets, capital went to commodities, capital went to gold, capital went to these other assets. And so US stocks were not really the place to be, and a lot of other assets were. And I think if we encounter like a 5 year period like that again, that could be a period where Bitcoin does pretty well, even as the stock market, the US stock market, doesn't do particularly well. That's kind of how I view it. I think volatile but favorable.
Well, we started the year around 93, 94,000. Are we still in a bull run, Lynn?
Short answer is I think longer term, yeah. I think that Bitcoiners got very attached to cycles. And I think especially as the asset gets larger, those cycles become less clear. Anytime a lot of market participants think they know how something works is when it tends to change. So
Yeah.
just when all like TradFi market participants were like, well, bonds always go up when stocks go down. As soon as they all know
Hmm.
that, that's when it stops happening.
Yeah.
Because it's already fully positioned for, and then it's not going to happen. Basically, everyone's seen the Bitcoin cycle so many times. They expect there to be a cycle, and cycles can change. And so I think it's less about the halving cycle. It's more about the liquidity cycle, but liquidity is complex in this environment. We've at least taken off some tail risks of politics for the next few years. So Bitcoin has always had kind of this like embedded
Right.
probability of like, what if the U.S. takes its gloves off and just goes after Bitcoin really hard, right?
Hmm.
Because I would certainly, tell every major financial institution in the U.S. that you can't custody your own Bitcoin.
Hmm.
Um, kind of go after it. That's at least off the table for a while. So I think that a lot of
Hmm.
the fundamentals look pretty good at the current time. So I expect pretty good performance over the next year or two. But it is subject to not having like a 30% market crash or things like that that could, temporarily push us lower that we'd have to then rebuild from.
Bitcoin's surprising resilience amid macroeconomic chaos, from Trump era tariffs to interest rate uncertainty, signals a major shift in the crypto market's foundation. According to Bloomberg's EE's Eric Balkunas, spot Bitcoin ETFs and Michael Saylor's MicroStrategy are acting as shock absorbers, soaking up supply with over $2.4 billion in net inflows this year alone. This deep institutional demand is keeping Bitcoin strong, consistently trading above its previous all-time high of $73,679, even as equity markets wobble. That's a divergence even skeptics can't ignore. Macro strategist Lyn Alden's framework helps explain this stability. She sees Bitcoin starting to mirror the role gold played during the 2003-2007 commodities boom, a neutral reserve asset in a world grappling with dollar weakness and capital rotation. Institutional ETF holders are proving to be strong hands, holding through Bitcoin's recent 30-day volatility of just 1.8% to 2.8%, a range that's remarkably gold-like. Meanwhile, Michael Saylor's relentless Bitcoin accumulation, now up to 531,644 BTC, is reinforcing Bitcoin's narrative as hard money. And when retail traders panic sell, institutions are right there, absorbing the dip, creating a stronger price floor and a market less prone to wild swings. What we're witnessing may be the beginning of Bitcoin's decoupling from risk assets, a trend Alden anticipates as global capital seeks alternatives to the dollar-dominated system. ETFs are now acting as a bridge, bringing traditional finance into Bitcoin's decentralized world. And this could set off a powerful, self-reinforcing cycle. Less volatility, more institutional adoption, even less volatility. The old retail-driven Bitcoin market is evolving. What's rising in its place is more durable, more mature, and more systemically integrated. So what do you think? Has Bitcoin finally proven itself as a true hedge against dollar weakness, or is it still too intertwined with traditional markets? Drop your thoughts in the comments. Like this video, share it with your crypto crew, and make sure to subscribe so you don't miss our next deep dive into the future of finance. Stay informed, stay ahead. The Bitcoin era is just getting started.